Hi, I hope you are doing well. In this presentation, we are going to study ISA, which is Accounting Policy, Accounting Estimate, and Errors. After completing this video, you will able to know what is the importance of accounting standard because it affects profit, assets, equity, compatibility of financial statement. This standard explains how companies should deal with changes in accounting rules, update estimates, and mistakes from previous year. Understanding IS 8 is very important for exams, practical accounting, and auditing. Understanding IS 8 is very important for exam, practical accounting, and auditing. Now let's move forward and talk about what are agendas. Introduction, importance of IS 8, objectives, scope, definitions, requirement, one simple example, and mistakes that commonly made, tips for exams, and summary of the lecture. Let's move forward and talk about introduction and overview of IS 8. IS 8 tells us three main things. First, how companies should choose and apply accounting policies. Second, how companies should change accounting estimates when new information become available. And third, how companies should correct errors made in previous financial statement. IS 8 exists to make sure the financial statements are prepared in a fair, constant way so user can trust the numbers. Now the point is why it's matter. IS 8 is very important because without it companies should easily manipulate. Let's take one example to understand this point. A company should change accounting methods every year just to show high profit. IS 8 prevent this by allowing change only in a specific situation. It also helps an auditor decide whether the change made by the management and genuine or misleading because IS 8 financial statements become more reliable and compatible. Now let's move forward towards our objective. The main objective of IS 8 is consistency and transparency. It ensures that accounting policies are applied consistently from year to year, and it ensures that any changes or correction is clearly explained in the notes. Like you can understand why the numbers change and whether those changes are due to the new rules, new information, or a past mistakes. Now the point is what you will get from it, benefits of user. IS 8 helps the user compare financial statement of different years. It improves the understanding of profit, assets, and liabilities. It increases the trust in financial reports. Investors, lend, and regulate can make a better decision because they know the accounting treatment is constant and transparent. The next heading is scope, which is IS 8 applied in three situations only. Oh, IS 8 IS 8 applied in three situations only. When company change policies, when company change in accounting estimates. Now the point is what IS 8 does not cover. IS 8 does not apply whether another IS when another IFRS standards give a specific transaction rules. For example, let's let's take an example when a new IFRS standard is introduced and explain how to apply it. It also does not apply to new transactions already recorded by another IFRS. Non current year adjustments are not treated as IS 8 changes. The next heading is key definitions of this wanted. I'm going to explain accounting policy. Accounting policy are the rules and methods a company uses to prepare financial statement. These include measurable based recognition principle. These include measurement. These include measurement basis, recognition principle, and principal methods. For example, let's take an example to understand it. Under IS 16, under plant and equipment, it can be recorded as cost model or regulation model. And the other example is IS 40, investment property. It can be recorded as fair value or a cost model. It's up to us where model we want to use. Change in the accounting policy affect how items are measured and presented in the. Now I will explain accounting estimate. Accounting estimates are based on judgment because of uncertainty. Let me explain with an example. Include useful life of asset, residual value, potential for a bad debt, and warranty of provision. Like if we know the useful life of our asset is 10 years, but in the middle of recording, we know that the useful life of our asset is 7 years, but we didn't know it from the start. It is accounting error, but if we know it from the start, it would be a different case. Credit period error are mistakes made in previous financial statements. These mistakes may occur due to the wrong calculation, incorrect classification, or misinformation. If reliable information was available at the time and not used correctly, become a credit period error. Key requirements. I hope it's understandable. Now let's move forward to key requirements of the standards. It divides into three main categories. The first category is policy change. When allowed, a company can change accounting policy in two cases. First, when a new IFRS standards require the changes. Second, when the new policy provide more reliable and relevant information. Accounting policy should not be changed just to increase and decrease profit. And how it's applied, the treatment. Accounting policy changes are usually applied retrospectively, which means we act as if the new policy was always used. Just like opening balances are adjusted, comparative figures are restated if the practical and full disclosure is required in the notes. The next key requirement is estimate changes. Estimate changes happen because of new information, better experience, or upload condition. The useful life of our machinery is 5 years, but because of heavy use, its useful life has become less from our estimate. It is the change in accounting estimates are applied. Now going towards what the change in accounting estimate are the change in accounting policy effectively. This means the change affect the current and future period only. The past financial statements are not restatable, but disclosure of the nature impact of the changes is required. Like if that information affect the decision of the user, it will change in the previous period. If it does not, then it would not change in previous period. What is error? Wrong calculation, wrong classification, or wrong policy used. What is the treatment? How we correct them? We correct them retrospectively. Like example, opening retail earning are adjusting at the start of the earliest period pres- present. Present. Comparative figures are restated if the practical. These ensure the financial statements show the fair and accurate past result. To classify any situation quickly, ask three questions. Then the accounting to classify any situation quickly, to ask any situation quickly, ask three questions. Did the accounting rules change? Yes, then it's a change policy change. Did the assumptions change? If it's a policy change, then it will be dealt retrospectively. Did assumptions change? Yes, then it will be a deal with prospectively. Then it will, if it's an assumption change, it deal with perspective. If it's not an assumption change, then past mistakes found, then it's deal with credit period errors. Discuss what common mistakes usually made. Commonly mistakes include treating estimate changes as a error changes, accounting policies without a valid reason, and failing to disclose changes properly. These mistakes can result in wrong profit, wrong equity, and different issues. And always start by identifying whether it's a policy, estimate, or error. Then clearly explain whether the treatment is retrospectively or prospectively. To conclude, IS 8 control how accounting change and errors are treated. Policies are usually retrospectively, estimates are judged prospectively, and errors are past mistake correct retrospectively. Quick recap is classify correctly, then apply method and disclose clearly. This is what examiner and auditor want to see. That's all for IS 8. I hope you would understand it. Thank you.